Selecting a settlement rail is not just a payment decision. It shapes regulation, liquidity, risk, compliance, integration, and client experience. In this section, we'll use a practical framework to compare rails and justify an enterprise-ready architecture choice. So far, we've built the core building blocks: market context, architecture choices, token models, smart contracts, and settlement operations. Now we'll bring those pieces together into a decision framework, weighing jurisdiction, liquidity, risk, compliance, and operating model. A settlement rail defines the operating model for value movement. It determines how the cash leg and asset leg stay synchronized when finality is achieved, and where risk sits if something fails. That decision is constrained by law, technology, operations, commercial terms, bank support, and jurisdiction. So there is no universal best rail. The architecture must explain why the selected rail fits the use case and why credible alternatives were rejected. No option dominates in every scenario. Fiat rails offer familiarity and legal comfort, but often sacrifice speed and programmability. Stablecoins are fast and blockchain native, yet raise questions around issuers, reserves, and redemption. Tokenized deposits may align more closely with banking regulation, but access is still limited. Hybrid models are common because they separate on-chain settlement from off-chain funding, reconciliation, and controls. A scorecard keeps rail selection disciplined. Instead of asking which technology we prefer, we ask which option best fits the use case. Finality, liquidity, jurisdiction, speed, cost, compliance, bank support, user experience, and readiness all matter, but not equally. Institutional settlement may weight finality and liquidity highest. Retail assets may weight experience and cost. The result combines hard metrics with judgment and supports executive architecture governance. Finality is not one checkpoint. It is a stack of assurances. A blockchain confirmation may provide technical confidence that a transfer will not be reversed, but the transfer also needs legal recognition through contracts and governing law. Operations then need to reflect it in ledgers, custody records, treasury balances, and reconciliations. Settlement certainty exists only when these layers agree. If one layer lags, firms can face disputes, breaks, or unclear asset ownership. Liquidity design starts before settlement begins. Participants need cash or settlement assets available at the right time, not just eventually. That means checking pre-funding rules, intraday liquidity, cutoff times, and bank operating windows. If a stablecoin is used, redemption must be predictable, with clear access to bank accounts and liquidity providers. Also test whether custodians and counterparties will accept it. The key question is simple. What happens when funding fails, redemption is delayed, or markets are stressed? Settlement design is not jurisdiction neutral. The same token, cash leg, or custody role may be treated differently depending on where the issuer, investor, bank, custodian, and validator are located. Before choosing rails, map the legal perimeter: securities, payments, e-money, digital assets, cross-border controls, and transfer limits. Architecture should follow that regulatory map. Think of settlement design as a set of trade-offs, not a race to 0 seconds. Real-time rails can improve user experience and capital velocity, but they can also create liquidity pressure, higher failure exposure, and tighter compliance windows. The better question is what each transaction actually needs. Issuance, transfers, redemptions, and corporate actions may each require different timing. Compare confirmation speed, throughput, fees, and operating workload together. Scalable systems balance speed with controls, reconciliation, exceptions, and support. Compliance cannot be bolted on after settlement. It has to travel with the transaction. Before execution, the rail verifies KYC, sanctions, investor eligibility, allow lists, and limits. During execution, it monitors AML patterns, velocity, geography, and restricted transfers, while validating the cash leg and asset lock. After settlement, it preserves evidence for reporting, audits, and regulatory review. The goal is strong control without slowing the market unnecessarily. Enterprise settlement does not end with the blockchain transaction. Fiat still moves through banks, reserves must be monitored, and every settlement event must become an accounting and treasury record. that requires reliable on and off ramps, bank data feeds, payment references, matching logic, and exception handling. Operational dependencies also matter: cutoff times, service levels, and support coverage. If these connections are weak, the rail may settle tokens, but the business cannot close its books. A settlement rail is ready only when real users can complete the journey without heroic support. Start with onboarding. Identity checks, wallet setup, and funding must be clear. Then test each transaction path, from subscription and transfer to redemption and coupon payments. Behind the scenes, operations need monitoring, approval workflows, exception queues, and escalation paths. Runbooks, SLAs, reconciliation schedules, incident procedures, and cutover plans turn the design into something teams can operate reliably. Rail approval should never be based on cost and speed alone. Each option needs a risk-to-control map. Who stands behind the asset? Can redemption still work under stress? Are sanctions, AML, and wallet risk checks operating before value moves? Are jurisdiction rules enforced automatically rather than manually remembered? For every risk, define the control, evidence, owner, fallback, and residual rating. That turns compliance from a late objection into a design constraint. Once a settlement rail is selected, capture it in an architecture decision record. The ADR should state the decision, business context, assumptions, constraints, and approvers. Just as important, record the alternatives you rejected and why. That creates auditability. Then document residual risks, required controls, monitoring obligations, and operational dependencies. Finally, include migration paths, such as stablecoins to deposit tokens, CBDC, or fiat rails, so today's choice does not become tomorrow's trap. Settlement rail selection is an architecture decision, not a technology contest. Use a scorecard, test regulatory and treasury risks, and document the rationale in an ADR. A defensible rail is one you can operate, control, and explain. Next, we secure execution through wallets, custody, keys, and signing.